Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Brand Engagement Network.
If you find our talks useful, please consider subscribe, like, and comment underneath. Okay, I have to be honest. I was looking at the charts this morning, and for a second I thought my screen was broken, or maybe that I'd pulled up some, I don't know, crypto chart from 2021.
It's been a wild ride.
It's been all over the map. I mean, we're talking about days with 600% surges. It looks like a meme stock. But you're telling me there's a real business under all this chaos.
It definitely has that roller coaster look on the surface, absolutely. If you just glance at the chart, you'd think it's pure speculation. But if you actually peel back the layers, what we're seeing is a classic turnaround inflection point.
Okay.
This isn't a GameStop situation. The movement isn't just driven by social media. Brand Engagement Network is a microcap AI stock that's shifted from, well, basically survival mode into a real growth story. And here's the most important part. They aren't trying to build another ChatGPT.
Which is good.
They're not trying to beat OpenAI.
Because fighting Google as a microcap, that usually ends pretty badly. It's like bringing a plastic knife to a nuclear war.
You just don't win that fight. Exactly. So instead of fighting the giants, they're cornering a very specific and very difficult market.
Which is?
Regulated industries. Think healthcare, pharma, insurance, banking, places where you just can't have an AI hallucinate an answer or, leak patient data. Compliance and data sovereignty are absolutely non-negotiable there.
Right. You can't have a chatbot making up medical advice.
Or exposing credit card numbers. That's their sandbox.
So they're the safe AI for companies with an army of lawyers. That makes sense. But let's talk about the price action. The elephant in the room. The stock has gone from, about $1 to trading near even $18. That's a vertical move.
It is.
And as a skeptic, I get skeptical when I see lines go straight up. I have to ask, is this just hype? Is this just people chasing a ticker that has AI in the description?
It's a completely fair question. But the argument I'm going to make today is that this is a fundamental shift. The market is waking up to the fact that they've moved from just burning cash into a model that could actually be profitable very soon. The chart looks like a rocket because the market is just now realizing this company isn't going bankrupt. It's actually signing huge deals. The market's just playing catch-up.
Okay, let's unpack that then. Because if I'm an investor looking at a chart that's up that much, I need to know what's under the hood. So the fundamentals. I glanced at the Q2 2025 revenue, and honestly, it was tiny. $5,000. Is that a typo?
It's not a typo.
My nephew's lemonade stand did better. How do you justify a market cap of $70–80 million with revenue that small?
You're right. The trailing numbers look almost non-existent. 5,000 in Q2, trailing 12 months around 75,000. If you only look in the rearview mirror, you walk away. The conversation's over. But remember, the stock market is a discounting mechanism.
Let's pause on that. For anyone who might be new to that idea, when you say discounting mechanism, you mean the market is pricing in what it thinks will happen, not what already happened.
Exactly. The price today is a bet on the future. On the cash flow investors expect 6, 12, 18 months from now. And that future outlook for this company changed drastically in the last few months. There are massive new catalysts that completely changed the math on that tiny revenue number.
Okay, lay them on me. What changed?
First, the pharma deal. They signed a vendor agreement with a top 10 global pharmaceutical client.
Okay.
Now, just in Q4 of 2025, that deal alone brought in $250,000 in development revenue. That's already 50 times their Q2 revenue.
In a single quarter. But is that a one-off? Development revenue is usually just a setup fee, right? You build it, get paid, and that's it.
No, and that's the key. That's just the development part. Once the system is deployed, it kicks into recurring license fees.
Ah, the holy grail.
Recurring revenue. That's the dream. And then there's the Valio partnership. It's a deal in Africa, involves a $2 million equity investment, a 25% stake, and this is the big part, a 35% revenue share.
35%. Wow, that seems really high for a partnership.
It is high, and it shows that their tech is valuable enough that partners are willing to give up a third of the upside just to use it. It validates the product. Plus, look at the bottom line. In Q2 2025, they actually swung to profitability, $900,000 in net income versus a $3 million loss the year before.
Wait, hold on. How do you get from $5,000 revenue to $900,000 in profit? That math, that doesn't add up.
It was largely from debt extinguishment. basically cleaning up the balance sheet,
Mhm.
and a massive 55% cut in operating expenses.
So they clean house.
They got lean, they regained NASDAQ compliance, and now they're signing these big deals. They stopped the hemorrhage.
Okay, stopping the bleeding is step one. But let's talk about the tech. Why are they winning these deals? If I'm a big bank, why wouldn't I just use the enterprise version of a generic AI?
Because they have a secret weapon. It's called the ELM, their engagement language model, combined with RAG.
RAG, another acronym. Break that down for someone who isn't a software engineer.
Okay, think of it this way. A standard AI, like the ones we all use, has read the whole internet. It knows a lot, but it also hallucinates. It makes things up.
Right, it invents things that sound plausible.
A RAG is like giving that genius a specific textbook, say a handbook on cardiac medicine, and telling it, you can only answer questions using this book. No improvising.
So it creates a boundary. It forces accuracy.
Exactly. It grounds the AI in the client's own verified data. And they've built this for secure, multimodal interaction, avatars, voice, text that complies with EPI, GDPR, all big ones.
So a hospital can't use a generic chatbot because it might leak data or give bad advice and they'd get sued.
Or the AI might take your proprietary data and use it for its own training, basically giving your secrets away. Their IP portfolio, 21 patents issued, 28 pending, is all built around this closed-loop safety. That's their moat.
That's a huge selling point in 2026. Data sovereignty is the next big battleground. Okay, the story sounds good, but back to the chart. This hockey stick recovery from $1.18 to over 18 bucks.
It's explosive, and the volume backs it up. We're seeing over 43 million shares traded on some days. This isn't just a few people pushing the price up. It's real institutional and retail interest.
But as a trader, when I see that vertical move, my RSI indicator is just screaming, overbought! Feels like the rubber band has stretched too far and it's about to snap back.
I get that fear. It feels like you're chasing.
It does.
But you have to ask why it's moving. I'd argue this is a repricing event. The market had priced this company for bankruptcy. At $1, they thought it was dead. Now with Swiss Life Value, the market is realizing, oh wait, they have real tech and real partners. It's a correction of a wrong valuation.
So the market was wrong before, and now it's catching up.
Precisely. And that news flow creates a feedback loop. There's a wall of worry, sure, but good stocks climb that wall.
Speaking of the market, what's the sentiment out there? Are we just seeing bots pumping this on message boards?
The quantitative data is actually fascinating. The sentiment scores we're tracking are consistently in the strongly bullish range. The news is all positive catalysts. But here's the huge opportunity. There is almost zero major analyst coverage.
Ah, the information asymmetry. My favorite.
Exactly. The big banks aren't covering a microcap like this yet. It's too small. By the time they do, the easy money is gone. Right now, retail investors, the people listening to this, have an edge.
But I have seen some retail skepticism, right? People calling it a pump and dump just because of the price action.
Yes, and that's healthy. If everyone was bullish, I'd be worried. You have a mix of bulls who see the tech and traders who just look at the chart and say, it's up too much, I'm shorting it. That short interest can actually fuel the fire if there's more good news.
Or powder keg.
It is.
All right, I've let you paint the rosy picture. Time for my job. Let's talk about the bear case. Let's get real about the risks, because when I look at the liquidity, yikes.
You're looking at the quick ratio, aren't you?
I am. And it's 0.01. That's terrifying. That means they have almost no liquid cash to cover their current bills. They are critically undercapitalized.
You're absolutely right to flag that. It is the single biggest risk. They are relying entirely on warrant exercises and partner investments, like the cash from Valio, to keep the lights on.
So they're living paycheck to paycheck.
They are.
And if that stock price drops, what happens to the warrant exercises?
The cash spigot turns right off. No one exercises warrants if the stock is below the strike price. They are walking a tightrope. They need the stock price to stay high to fund operations.
So the stock price is the business model right now. That's a very precarious position. And then there's the execution risk. Everything hinges on converting these pilots to production.
Pilot to production. That is the entire ballgame.
Right. If that big pharma client runs the pilot and says, thanks, but no thanks, this whole thesis collapses.
The stock goes back to $1. That is the binary risk of early-stage tech. You're betting on adoption. If the pilots stay pilots, the company fails. It's that simple.
And the volatility. This is not a retirement stock. You could lose 20–30% in a week.
Agreed. You have to have the stomach for it. If you panic at a 10% drop, stay away.
Okay, so we know the risks, we know the potential. Let's wrap this up. What's on the catalyst calendar for the next 3 months?
It's packed. First, Q4 earnings around March 30th.
That's the moment of truth.
It is. We are looking for validation of that $250,000 pharma revenue. If that number hits, it proves the model works. If it's missing or less than expected, look out below.
And the partnerships.
We need to see updates on the ramp-up for Swiss Life in Europe and Valio in Africa, and specifically the Nelson Mandela University pilot.
Why is that one so important? It sounds small compared to a global pharma deal.
Because mental health is the ultimate test for AI. It's incredibly sensitive. If they can prove their AI can safely handle mental health interactions, it validates their entire safety mode. If you can handle that, you can handle anything in healthcare.
That would be a massive proof point. Okay, so putting it all together, the turnaround, the tiny revenue, the big deals, the scary balance sheet, what's your score?
I'm giving Brand Engagement Network a bullish score of 7.2 out of 10.
7.2. That's a strong score for something this risky. Justify it.
Because I see it as an asymmetric trade. The downside is 1x. You lose your money. The upside could be a multi-bagger if they execute. The investment thesis is this. It's a swing trade into the Q4 earnings in March. You play the hype and the anticipation of that revenue number.
And long term, for someone who wants to hold for years.
If, and it's a big if, they prove the pilots can scale to 5 or 10 million in revenue over the next 12 to 18 months, then it's a hold. But you have to watch those earnings reports like a hawk.
So maybe ride the momentum into March, but keep a very tight stop loss.
Exactly. And the final thought I want to leave you with is to focus on that data sovereignty angle. In 2026, companies are getting really scared of open AI models. Owning your own AI data in a regulated, closed loop, that's the next big battleground. Brand Engagement Network is selling the armor for that battle.
That's a great point. It's about the macro trend, not just this one stock. Well, that was a wild one. From $5,000 in revenue to a potential global player.
Never boring in the microcap space.
It certainly is not. Remember, everyone, do your own due diligence. We're analyzing the data, but it's your money. If you found this breakdown useful, please consider subscribing, liking, and drop a comment. Let us know, are you buying the turnaround, or is the cash crunch just too scary?
We'll see you in the next one.
Thanks for listening to Smart Wealth with Joshua.